So, welcome everyone. I'm Pamela Yellen, the founder of Bank on Yourself. And thank you so much for joining us today. We do have a great agenda lined up for you, and we hope that you blocked off 75 minutes for this presentation, and that will include time for questions and answers. First, a little bit of background about myself if you're not familiar with me. I'm a consumer advocate and financial investigator. I am not a licensed financial advisor, but I've researched over 450 different financial strategies and vehicles. And I've also written 2 New York Times bestselling books, including The Bank on Yourself Revolution. My latest book, which many of you have, is called 5 Wealth-Killing Traps of 401ks, IRAs, and Roth Plans, and How to Avoid Them. It was fully updated at the beginning of 2024. Now, over the past 2.5 decades, we've helped more than 500,000 families and businesses reach their financial goals and dreams without taking any unnecessary risks. Our focus is on safe wealth building and guaranteed lifetime income strategies. I'm thrilled to be joined today by Mark Willis. Mark is a highly trained and experienced Bank on Yourself professional. He's also a certified financial planner, which is actually a very difficult designation to obtain. He's a 3-time #1 best-selling author, owner of Lake Growth Financial Services, and co-host of the Not Your Average Financial podcast. Mark has helped hundreds of clients enjoy control of their money, numerous tax advantages, guaranteed predictable growth and lifetime income, and eliminate high-interest debt. He's going to demonstrate why the Bank on Yourself strategy is often called the Swiss Army knife of financial strategies. Mark, thanks for joining us today.
Pamela, so glad to be on. Thanks for having me, and what a great opportunity to talk with many of the folks that you've been able to discuss strategies like this with before, but now do it in this live format. So thank you.
I know it is exciting. I haven't done this for such a long time. You can probably tell I'm a little nervous, so bear with me.
Oh, you're doing great.
So let's quickly overview the Bank on Yourself strategy. It's a proven, safe wealth building strategy that has increased in value every single year for over 160 years. It's guaranteed to grow by a larger dollar amount every year, no matter what happens in the market or the economy. It's based on high cash value, low commission, dividend-paying whole life insurance. But this is not the kind of whole life insurance most people and advisors know about, because options are added that supercharge the growth, and commissions are slashed by 50 to 70%. It's a very versatile tool that you can use as a powerful money management tool from day one. And it's been called the Swiss Army knife of financial strategies because it has so many different uses, and we're going to cover 3 of them today. But before opening up for questions, at the bottom of your screen, or at least for most people, there's an icon labeled chat. And we would like you to, we'd like to know who's joined us today. So please put where you're calling from in the chat box now. And Jamie, our operations manager, will share a few of them. So I know it takes a minute for people to.
Wow, no, they're
but
flying
I can.
in.
Oh my gosh!
All right.
And I do want to mention we have hundreds of people on the call today, so it's very exciting. And again, I apologize for being a little nervous.
Yeah, good luck, Jamie, reading all these out.
I'm going to try my best. We've got Morgan from California, Mark from Texas, Jeffrey from Ohio. We've got Thomas from San Jose, Frank from Albany, Robert from California, Amy from Omaha, right? Let's see, Latia from Florida, Sean from Texas, Dennis from Indianapolis. Ooh, Chris all the way from Hawaii. Hello, Chris.
Oh,
Allie
wow.
from Oregon. Judith from Maine. Samuel from New York. Nick from Tallahassee. Abe from Colorado. Wow, we're all over the place. Lots of
Yeah,
Californians.
we're not going to have time to read all of them, unfortunately. But thank you so much for joining us today. So here's the next instruction I want to give you. One more. So as we go along, if you have a question or a comment, do you see the Q&A icon? Not the chat icon, the Q&A icon. And that is where we would like you to type your question or comment in. And then at the end of the webinar, we're going to address as many of those questions as we possibly can. Now, here's what you're going to discover on today's webinar. We're going to cover 4 dangers of IRAs and 401ks and how to avoid them. How to have a tax-free retirement and protect yourself from the coming tax tsunami. And I'm really happy about this because this is a popular use of the Bank on Yourself strategy, and Mark Willis has had tons of experience with it. I have too, but Mark's had tons of it. And that is game-changing strategies for building wealth through real estate. So I hope you blocked off another 70 minutes to hear it all. And at this point, I'm going to turn it over to Mark Willis. Mark, if you're ready, you can take over the screen and take it away.
All right. Thank you, Pamela. Awesome. And welcome, everybody. I really hope you're going to be taking notes as we jump into everything together. Please write your questions down as you have them. Don't wait for the end, because if you're like me, you'll forget about it before you get to the end of the presentation. So as you have the question, jot it into the area that Pamela already mentioned in the Q&A section. Is that right, Pamela?
That's right. It just makes it easier for us to find the questions in the middle of the literally well over 100 people who put where their name and where they're calling from.
That's right.
And so this way we can find just your questions and answer those.
That's right. So first come, first serve, it looks like, with the questions we might be having. So let's get right into everything we've got to cover. And first of all, I'd like to know, and feel free to put into the chat as we go. I do like the interaction. If it's not a question, I suppose it's okay to put into the chat a comment. But if you do have a question, remember, put that into the Q&A section. But here in the chat, put any kind of, has anybody ever owned a Swiss Army knife? So just yes or no. Yes or no. And I want to ask you too, have you ever been saved by your Swiss Army knife? Think about that for a minute. I get it. Maybe you're not MacGyver from the hit TV series, but he used his Swiss Army knife to escape all kinds of crazy situations with, makeshift tools. And, maybe he used his Swiss Army knife to cut through a rope on his, tying his wrist together. Maybe it was the tweezers on the Swiss Army knife to disarm a bomb, or maybe just the toothpick to bypass a locked door. MacGyver had it figured out. He knew that Swiss Army knife was crucial. Or did you know that the Swiss Army knife, the humble Swiss Army knife, is with every astronaut when they go into space? Because every ounce of weight matters when you're lifting off from Earth's gravity. You need a multi-purpose tool to help you repair equipment, or to cut a tether, or even to perform a minor surgery out in space. Isn't that cool? And of course, there's everyday heroes fixing loose screws with their Swiss Army knife, opening a jammed window, or if you're like me, using it to open up the 15 packages from Amazon that arrive on my doorstep every single afternoon. So if that's you, I want to ask you this next question. What about your money? Do you have a Swiss Army knife in your financial portfolio? Something just as powerful, just as useful, with multiple purposes. That's what I want to talk about together today. What you're going to discover, as Pamela mentioned, why the conventional retirement vehicles have 4 flat tires, and how to avoid them in your own financial life. We're going to talk about how to bypass Wall Street and grow your wealth safely every single year, regardless of market conditions. And no matter when you might be watching this, or if you might be watching this as we're recording it, The market is going to do what it's going to do, but what about your money? Should it be tied to the whims and the gestures and the emotions of Wall Street? And what about creating a tax-free income in retirement? How might that impact your financial future, especially if you believe, like many people do, that tax rates might be going up over the long term? And what about leveraging your assets? Not just letting it sit, soak, and sour inside some sort of account somewhere, but using your assets to generate future income, future wealth through real estate investing and more, and a whole lot more. In fact, it's infinite. So this is in my own imagination, this is sort of how I look and view when I open up my Bank on Yourself policy statements. It looks something like this in my imagination. Now, maybe that looks a little menacing, but I kind of think of it like, wow, look at all the fun adventures we could have with this. What we're looking at are today 3 tools in this overall, set of tools that can be used within the Bank on Yourself system. And again, we're going to be focused on how dividend-paying whole life insurance designed the Bank on Yourself way, just as Pamela has written about in her books. How dividend-paying whole life is one of the most, if not the most versatile tool in the financial universe, including with it the first tool, which is guaranteed growth. We're going to talk about how important that is in your overall portfolio. We're going to talk about how the special tax nature of life insurance can provide, if done properly, a stream of income that does not report to the IRS, a tax-free income in retirement or even before retirement. And again, how we're going to use this for other investing options such as real estate and so much more. Now, first things first, we got to talk about these 4 flat tires that come with conventional retirement plans. If the Swiss Army knife is the most useful tool, what would be the least useful tool? In my opinion, the opposite of a Swiss Army knife is a flat tire. Literally, the tire has one job to do, and if it's flat, it failed. It has one job, and if it can't drive your car, what use is that tire except just to be a drag on your vehicle? Can you imagine if your money was as useless as a flat tire? But unfortunately, so many traditional retirement plans like 401ks and IRAs are just as useless. And here are 4 reasons why. The first flat tire on conventional retirement accounts is that there are no guarantees. In fact, the only person who is guaranteed anything with your traditional retirement plan is the investment advisor who's getting fees off your back, no matter what the market does. But I'm getting ahead of myself. That's for later. Let's talk about all the non-guaranteed parts of your retirement accounts. Number 1, there's lots of nails in this tire, right? There's the non-guaranteed stock market or bond market. No one knows what the future of that market will look like when it's time for you to tap into it. Next, how much are you going to take out of your retirement account when it's time to retire? Think about that for a minute. Even if you had $1 million or even $5 million in your various retirement accounts, how would you know exactly how much to take out so that you would never run out of income? Impossible question, because no one knows how long we're going to live, right? And that's the next nail in this tire. Longevity risk sounds kind of weird, but it's actually the most dangerous risk of all, because the longer I live, the longer you live, the more we are exposed to every other risk in the universe. Markets keep going, right? Interest rates keep going. Even fraud or theft. The longer you live, the more you are exposed to every other risk. And it's hard to know how long your body's going to run. Next up is inflation. We have the trouble of inflation right now, but is it possible that inflation could still be with us 10 years, 20 years, 50 years from now? With all the debt we carry as a country, don't you think that interest rates might go up or stay up or even increase from where they are today? And finally, this last one is sort of the wonky one among them all, but it's called sequence of returns risk. And kudos to you if you know what that is. Most people don't. I didn't, even as I was going through my CFP studies. But let me explain this to you with some real numbers. So here's Jane and here's Jim. Both Jane and Jim are each 65 years old, and they both are ready to retire. They both start their retirement with $500,000 set aside for retirement in this, hypothetical account. They are both going to take exactly the same amount of income out of their retirement account, starting at $20,000 a year. And they're both going to just let that increase a little bit with inflation as the years go on. Now, at the end of the prevailing years, Jane only has $74,000 left, while Jim sits on a substantial $344,000 after 15 plus years here. So why is there a difference? They both had all the same numbers. They started with the same income. They started with the same beginning balance. They're both taking the exact same money out. They both They both had the same average rate of return. So what was the difference? The only reason one became greater and one lost so much was the order in which they received their market rate of return. So the average rate of return was the same, but the sequence of that return, I just flipped it upside down. Notice the returns are mirroring each other. And because of that fact, because of that one sole fact, Jane is running out of cash when she's only 81 years young. And can you imagine how that might feel? Now, that is the one thing that Jane had no control over, which was the order in which she received the market-based returns.
Yeah, just a quick comment about that. It turns out, as you just pointed out, that when you begin to take withdrawals, market volatility has a far greater impact than rate of return. And if you have the wrong sequence, as you're showing, it can be extremely difficult for you. It could mean you have to cut back significantly on your retirement lifestyle, or you're forced to work longer or go back to work. And the big problem, of course, is that there's no way to accurately predict when the next market crash will happen or where the markets will be when you're ready to retire. And that worst period, when you're the most vulnerable, is 5 minutes, about 5 years before retirement and 10 years after retirement. And if you have a crash during those years, you may never recover from it, which is obviously why one way to protect yourself from this very real threat to your retirement lifestyle is to diversify your assets. So back to you, Mark.
That's right. And just like that, not just diversifying it among a couple of different mutual funds. It's fine to diversify among a couple different stocks, bonds, mutual funds, but that's sort of like putting your eggs in 12 different baskets, which is fine. But what if all your baskets were on the same truck and that truck goes off a cliff? What good did all that diversification do us, right? So what you're saying, Pamela, is move some of that money onto another truck. Non-correlated assets is the fancy word here. So, as you mentioned, we're looking at the difference between average and real rates of return. Compound growth is not the same thing as an average rate of return. Remember, Jane and Jim had the exact same average rate of return. And the stock market over the last 120 years has averaged over the last 120 years has averaged a 10% annualized average rate of return. However, over a lifetime of investing for the last 30 years, real investors have only averaged a mere 4.3%. Now, how is that possible? Let's take a look. So this chart shows in nominal values a $1,000 investment into the stock market of roughly 100 years ago, and showing a 6% compound rate of return, and also a 6% average rate of return. In fact, if you can see the orange line, both orange and blue lines equal a 6% rate of return. Now, if you're looking at the screen as we're recording this, the orange line is clearly the winner at a little over $1.3 million of final value, while the blue line is merely at about 500 grand. So what gives? Mathematically, both of these lines equate to a 6% rate of return, but the top line experienced no volatility. Now, here's the catch. Investors think they're going to get the orange line. The blue line is what we all actually receive, and you cannot go back in time and fix it. Once you've earned your returns and you're 72 years old or 75 years old, there's no undoing this problem. So too many people say to themselves, hey, I'll just have to take more risk. I'll have to put more in the market, or worse, I'll have to put more at risk because I can't save that much. unfortunately, the difference here is profound. The difference between average returns and real returns is huge. And this is a shocking truth that shocks many people. And according to third-party research firm Dalbar, asset allocation investors have essentially had no growth for the last 30 years after adjusting for inflation. Now, what the heck is an asset allocation investor? Well, that's all of us. If you have a 401k or an IRA, the majority of money in 401k plans are in asset allocation funds. That would be a mutual fund or ETF or target date fund. That's 98% of all retirement accounts are being baked with these underperforming buy it at the mall ingredients. And they're all giving us essentially no growth when we factor in inflation. Over 30 years. Now, were the last 30 years full of restful nights and no problems in the market, or were there plenty of restless nights and anxiety with market turmoil and world economic trouble and more? So was it worth it for the last 30 years to invest in the stock market with these kind of results? Let's take a look at someone else's story. This time, we'll take some real numbers from Dan. Dan was doing all the right things, but he was getting nowhere with his investing. He had made it through the tech bubble, gone up and gone down. He had made it through 2008 and the world financial crisis. He went up with his account values and retirement plans, and he saw those crash as well. Finally, he was ready for a change. And when he was interviewed by Pamela Yellen, he mentioned to her, he said, when you put your money in things that don't lose money, you only make money. Now, that's one of those, I call them BFOs, brilliant flash of the obvious. But it's such a brilliant comment. When you put your money in things that don't lose money, you only make money. So let me show you what this looks like with real numbers. This is Dan's actual net worth chart he was kind enough to share with us. So from 1999 to 2009, you can see his net worth essentially stayed relatively unchanged. Sure, there was plenty of volatility up and down, but that was, as Pamela says, paper gains and paper losses. However, in June of 2009, he opened his very first bank on yourself type policy and began to build in real wealth, contractual wealth, and his net worth has nearly tripled in 10 years. So that chart regularly surprises me. Pamela?
No, I was just going to say, Dan, it was so sweet of Dan to be willing to share his story, but he's one of those people who said when he first heard about Bank on Yourself, he thought it was a ripoff. So he decided, anyway, I'm going to investigate, and he did. And he ended up, he is a massive Bank on Yourself revolutionary. He owns numerous policies and annuities and a total believer in it.
And a great guy to boot. Great guy to talk to and great person as well. So thank you. So that's our first flat tire, that there are no guarantees. Let's move on to the second flat tire, fees, that other F word. The 401k and IRA provider is not a charity. I hate to break it to you, but they are out to make a buck, and you are their customer. In fact, fees are the only guarantee in your financial vehicle at all. And by the way, while we're talking about compounding, there's the beauty of compound growth, but there's also the tragedy of compound fees. Fees destroy your growth. In fact, just a 1% fee will destroy 28% of your entire nest egg over a 35-year period, according to the Department of Labor. Now, just so you know, when you're looking at a S&P 500 chart or a Dow Jones chart, those aren't assuming any fees as you look at the chart, and that beautiful, wonderful 10% a year or whatever they claim from the stock market. That's assuming no taxes and no fees. But we know as real humans, we all experience fees and we all experience taxes. But when you ask people, hey, are you aware of any of the fees in your retirement accounts? Most people say no. But there are a ton, sometimes over 30 different types of fees. We don't have time to get into all of them right now, but just a few of them. Did you know that there are, in many 401ks and IRAs today, a revenue sharing plan between your employer, your boss, and the 401k manager? Now think about that for a minute. They're both taking money out of your pocket. Is that even legal? How about mutual funds? They can charge extra fees to market their fund to somebody else. So you are paying for the mutual fund to advertise themselves to your fellow colleagues and work coworkers and more. Is that right? Even low-cost exchange-traded funds have significant compounding fees, and they crush you over time. A 1 to 2% fee in your retirement account can be devastating. In fact, they can eat up even 50% of your nest egg. I want to show you what this looks like with some proof. So when you're paying a 1 or 2% in fees yearly, what does your account value experience? Let's look at, first of all, on the left side of this chart, you're going to see, essentially no fee. If you put in $100,000 into an account and it grew at, let's say, 7% a year, well, after 35 years, you'd have $1,067,000. Not too shabby. With zero fees, but a 1% fee, you'd lose $307,000 and only have $759,000 left for yourself. That's 28% lost to 1% fees. Fast forward to a 2% fee, and you, instead of having $1 million, only have $538,000 left. That's almost 50% gone to fees. Oh, by the way, that's a half of your life savings going to somebody else to help him or her retire instead of you. So somebody's getting rich on this, but it's not you.
Mark,
Yep.
that company Brightscope that does the research on the fees in these plans also says that the number of plans that have fees that are higher than 3% was shocking. Imagine a 3% fee would take 3/4 of your retirement savings. And if you're in a small company as opposed to one of the huge companies, you're getting hammered on the fees. The small companies pay the most in fees.
Yeah. Wow. That's crazy. Unbelievable. It seems, because it's so little spoken about, and I'm so glad you've been bringing it to our attention for years now, Pamela. I think you've probably saved many people, a heartbreaking realization when they're halfway through their 401k statement and they finally see just what has been taken from them. So thank you. Awesome. Okay, so third flat tire is the money is in prison. Anybody here ever get a boot on their vehicle? Put it in the chat. Have you ever had your car booted? I have. It's not fun. I lived in downtown Chicago for many years. I walk out to a parking lot where I think, hey, parking lot, that means park your car here. No, no, not in Chicago. There was a boot on my vehicle and I could not access my car. It was there, but I couldn't use it. And there are similarly restrictions and prohibited transactions and penalties. When you try to access the money in your traditional retirement account, they're going to tell you you have restrictions on how much you can put in there, what you can and can't invest in. Rules can be changed at any time and any place. All they have to do is vote on it. They're in Congress. They can decide how much you can access, how much you have to borrow from them, and when and how you have to pay it back. Or you owe them a bunch of taxes and penalties. I had a guy, he was a client, he had an IRA. It was a self-directed IRA. And he thought to himself, okay, this is a retirement account. I'll just use my IRA, a retirement account, to buy my retirement home. So he bought his retirement home with his IRA funds. Well, it turns out that's not a allowed transaction. And the IRS considered it fully taxable. The entire account balance was fully taxable with a penalty in the current year. So that was a no-no for sure. So there are plenty of restrictions. And a colleague of mine, Doug Peacock, he says, when you get into an IRA or a 401k, it's like buying a car when you're 21 years old, but you can't drive it until you're 59 and a half. So there are tons of puppet strings, as Pamela calls them, on the 401k and IRAs. Yep. Just plenty of ways to keep you from being able to access your own money. It's almost like the government doesn't think you're a real adult until you're a certain age. And even then, they put limits around what you can use it for. And if you wait too long, they put limits and penalties on the money you should have took out but didn't. So there's limited control on 401ks and IRAs. But when you contrast this to a bank on yourself type policy, there's unlimited access. You can use the policy's cash value for any reason, for personal needs, business needs. I've used my policies to pay off debts, to go on vacations, to invest in real estate, and a lot more. So we've all put our money into these risky traditional retirement accounts where there are no guarantees, and we only keep a very little bit of money in a safe liquid bucket like a savings account at the bottom of this unstable pyramid. It's like living underneath an unstable pyramid that could topple over at any minute. In fact, 47% of American households say they couldn't cover an emergency of just $400. That's according to a report from the Federal Reserve. $400 in liquid cash reserves. The rest of it, where's the rest? It's in their 401ks and their IRAs and in their home, all of which have no guarantees and there's very little access to the money. So big and little financial surprises are a given in life. So what do most people have to do? They have to go into debt to cover the roof replacement or their child needing some extra help at college or getting hit with a big tax bill and more. But what if you could build your financial pyramid the right way with a safe, predictable, accessible, liquid fund at the base with only a manageable and limited amount at speculative risk at the top? That sounds like financial sanity to me. So keeping access to money safe and liquid is the solution to the third flat tire. Let's talk about that fourth flat tire, which is that these conventional retirement accounts are ticking tax time bombs. And if you blow up a time bomb inside of a tire, it's going to turn into a tire fire like you see on the screen here. Most people look at their 401k or IRA and think, oh, yeah, that's my account. That's how much I have worth. That's my money in there. But they forget that they're partners with the IRS in their 401k, in their IRA. A big chunk of that IRA and 401k is not yours. It doesn't belong to you. It belongs to your Uncle Sam. That's a very big deal when other people have hands in your retirement account. Now, the next piece is this wonderful magical word called tax deferral. And many investment advisors, many financial professionals, even CFPs like myself, they love to discuss the tax deferral magic of 401ks and IRAs, but I'm not convinced. The word deferral just means you have to push it off into the future. And oh, by the way, while you're pushing off the taxes, you're paying a fee on the money that will ultimately be paid to the IRS. Let me say that again a slightly different way. If you have $1 million in your 401k, you're paying the fee that the government will ultimately take fee-free out of your 401k when it comes time to pay the tax. You'll pay your taxes to the IRS, and that's money you had paid a fee on for the last 10, 20, 30, 50 years, however long you've had the account open for. Something is rotten in Denmark. I mean, that's a generous notion that you would pay the government's fees for them to invest and let you take all the risk and pay all the fees. How generous of you. Now, in the meantime, we have a significant national debt that continues to climb each and every month. And isn't the Congressional Budget Office predicting at least $1 trillion deficits every year into the foreseeable future? And isn't it possible that they would increase taxes or lower government spending, or even worse, borrow more and more and more money, inflating our money supply and decreasing the value of the dollar? If all that happened, or even some of that happened, what kind of impact might that have on you and your family and your financial future? Think about that for a minute. So, how do all these four flat tires really stack up? Remember, there are no guarantees with conventional retirement accounts. There's a compound nature to retirement plans, but it's not on your money. It's a compounding fee against you. Third, your money is tied up and locked away. You cannot use it for the things you might need or have to spend on throughout your working years. And fourth, each tax-deferred financial vehicle is a ticking tax time bomb waiting to go off. What if tax rates double in your future? Do you think they could? And more importantly, do you want to pay those taxes?
Yeah, an important point about the tax deferral. This is one of those conventional wisdom things that everybody believes, but nobody really looks at. Maximize your contributions to tax-deferred plans like 401ks, IRAs, and 403bs, because your money compounds without being reduced by taxes, and you're going to end up with more money during retirement. Well, it ain't true. And I started revealing that years ago with evidence backed up by the Society of Actuaries that agrees with me on that. And people started calling me a scam because of it. Oh, you're lying about that. So that's why I, put a calculator on the Bank on Yourself website where you can go and you can prove it to yourself. Are you going to be showing that yourself? Okay, you're going to show it. Great, because it's mind blowing. So the thing is, it's going to be the same dollars. It's going to be the same percentage of that you're going to pay, except if tax rates go up, which is when I survey people, almost everybody says, yeah, of course they're going to go up. I mean, not just the national debt. You've got all these people drawing on Social Security and Medicare, and Congress continues to spend like drunken sailors. So taxes
That's an insult to sailors there.
I know it is. Oh, well. But taxes are almost, as Doug Rosen, he's on the call, he's made a few comments, and he says they can't do anything but go up. And
That's
if
right.
you believe otherwise, I've got a $10 Rolex watch I'll sell you. But, after this presentation, just write this down. Don't do it now because there's a lot more valuable information we're sharing. Write down, go to bankonyourself.com after this, and put in the search box, tax deferral scam, and you can prove it to yourself. It doesn't matter what the tax rate is. If you defer your taxes and taxes go up, you're going to pay much more money in the end. All right, back to you, Mark.
Great stuff. And I'll pass it back to you in just a minute here. But Pamela, that's great stuff. And remember, everyone, as you have questions, put the questions in the Q&A box. If you just have a comment, please feel free to keep putting those in the chat. I see those coming up. So this is awesome stuff. As we wrap up this first section, I just want to ask a couple of questions. Pretend for just a minute, looking over those 4 flat tires, let's kind of zoom out for a minute, right? We've kind of been dwelling in the problem, but let me just zoom out. Pretend for a minute that you were able to start from scratch. If you were building a brand new retirement vehicle with working tires, you could do anything you wanted. You could design this financial vehicle any way you wish. If you were Pope of money for the day, could you build a retirement account with all the solutions to what these problems are, or would they be riddled with the issues that we're all discussing on today's call? Would you design something with all the problems we've been discussing, or would you design something that helps you accomplish your goals without taking a bunch of unnecessary risks, compound fees, problematic taxes in your future? Do you want guaranteed growth on your money every year? Ask yourself that question really. Would you, if you had the option, would you choose guaranteed growth? How might it help you most if you had access to your money today and not waiting decades for the government to finally grant you approval to your own money? Or how about having tax-free income retirement? If tax rates go up or even double from where they are today, how might that impact you and your life in your future? Now, what if I told you that this financial vehicle already exists and you could take advantage of it right now? That's the next portion of this webinar. It's tax-free income in retirement. Before I jump into that, is there anything else, Pamela, you'd like to share, or next steps for folks that would like to learn more? Anything before I jump in?
I think you're going to do tax-free income, and then you're going to do the game-changing strategies.
Absolutely.
Okay, keep going.
Keep rolling. All right. So now that we've covered these 4 flat tires of conventional retirement plans, I want to discuss how Bank on Yourself could allow you legally to have tax-free income in retirement. Let's start with that. That's one of the multi-purpose tools of this incredible Swiss Army knife. It's one of my favorite parts of the Swiss Army knife of Bank on Yourself. So let's start with a couple of questions. And many of you have already been cluing into the question, but I want to ask it again. Do you think taxes will be lower or higher in the future? Yes or no? Do you think taxes are going down or up? Do you think taxes will be higher in the future? Put it in the chat. Do you think taxes will be higher in the future? Yes or no?
We've
Go ahead
got
and put it in the
everybody
chat.
putting in high. They're all saying higher.
Higher. Okay.
Except for here's one. Yes, way higher.
Way higher. Okay. Could they be way? That's the next question. Could they be way higher? Could they even double? Think about that for a minute. Could they double where they are today? And here's the most important question of all. Do you want to pay those taxes? Are they going to take the money from people who don't own any assets to pay the tax bill? Who didn't save, who didn't set aside a 401k? Or is the government going to take money from those of us who did set aside and save for our futures? Are they going to get the money when they must raise the tax revenue? That's the key and maybe most important question you could ask as you look into a future where tax rates might and maybe likely will be going way higher. So, how could you have a tax-free future? Wouldn't that be amazing? I'm not always great at math, but I can tell you that 2 times 0 is still 0. So if they double our income tax and I'm paying 0, that's still a 0 in my book. So dividend paying whole life insurance is a financial vehicle that offers tax-free retirement income. It offers a unique way to take 30 grand a year, 100 grand a year, $500,000 a year out of your whole life policy and report 0 of it on your tax return at the end of the year. We're going to explore how this financial vehicle works and how you can use it to reap significant tax benefits and build real wealth at the same time. Now, we talked earlier, Pamela, about tax deferred, but I like to use the phrase tax postponed. Tax deferred sounds kind of magical, sounds like you're sort of cheating the system a little bit, right? But tax postponed has a different ring to it. There's a deferral mechanism when I think about my dentist. I try to defer my visits, but that's not always a smart idea, is it? Would you really want to put off something that's only going to get worse over time? Now, what about the farmer? I want to tell you a quick story about someone who gets a knock at the door by the IRS agent who comes in, sits down at the person's table who happens to be a farmer, and the IRS agent asks the farmer, who's confused as to why this IRS agent is there. He says, well, hey, Mr. Farmer, we were looking over your fields and managing your fields, farm fields here. We're just curious, if we gave you the choice to be taxed either on today's seed or the harvest tomorrow, which one would you rather be taxed on? And the farmer doesn't even have to think. He says, well, of course, I would prefer to be taxed on the kernel today so I can have a tax-free harvest tomorrow. And the IRS agent makes a few notes and thanks him for his time and walks out the door. And before he walks out the door, he looks at the farmer and says, just curious, if that's true, if you'd rather be taxed on the seed today, why are you doing anything different with your retirement accounts? And so many Americans are doing the exact same thing. They all, like me and like most of us on this webinar, we all think taxes are going up in the future, and yet we're putting our money into a tax-deferred vehicle, which will only hurt us later on. So back to Pamela's incredible tool. I want to show this to you guys. This is a picture of what we've just been describing and the proof that deferring your tax does not give you any kind of higher rate of return or net benefit. Here's what I mean. Let's pretend that you have $100,000 set aside into some sort of tax-deferred vehicle like a 401k. And let's pretend in this example that you're at a 25% tax rate. It does not matter the amounts. It doesn't matter the rate of return. So let's just give it a 6% rate of return. As you can see, in the first year, you have $100,000 with no taxes due. Pretty cool. So you get a 6% or $6,000 growth on your money in that first year. Fast forward down to year 25 at the bottom of the screen, you'll see that you've accumulated $429,000. Woohoo! Feels great. Unfortunately, to get the money free from the clutches of your 401k, you're going to have to pay the toll. And the toll is valued at $107,000. That's 25% of your account value, leaving you with a net amount of $321,890. Remember that number. That's going to be important here in just a minute. $321,890. Got the number? Okay. Now let's compare this to a tax-free or harvest-free retirement strategy, such as a bank on yourself type policy. In this case, we put $100,000 in. Well, we have to pay our taxes up front, don't we? So we're only left with 75 grand after tax that we now are earning 6% on, which means at the end of year one, instead of 106 grand like our 401k might have or our IRA might have, we only have 79,500 bucks available to grow and compound at the end of year one. So it's clear, right? The tax deferred strategy is going to win. Well, let's fast forward just a little bit down 25 years. Notice we've grown our money, same rate of return, same situation, everything is the same, but we've grown our money to, wait for it, $321,890.30. Where have we seen that number before? Oh yeah.
Yep.
It's the point of this story. The moral of this little chart here is that everything is the same, and it does not make a difference whether you put money in after tax or before tax. The only change is, where do you believe taxes are headed in the future, down or up? If taxes are even up 1% from where they are today, then mathematically it makes more sense to pay your taxes on the seed and have a tax-free harvest. And where can we do that? Inside a Bank on Yourself designed whole life policy. Again, dividend paying whole life insurance. It's one of the biggest advantages of dividend paying whole life insurance. It offers tax-free income during retirement. There's so many tax advantages. We're going to cover just a few of them today. First of all, tax deferred accumulation. Now, what does that mean? It just means that as your cash value builds up, you're not getting a 1099, you're not getting a tax form on the interest or on the dividends that you're accumulating within the contract. This is altogether different than, say, a savings account or CD or money market account where you are taxed every single year. So that's a huge savings right there. Next, you can access the money both today and in retirement with no taxes due. This is an income tax-free strategy. Again, all this is under current law, so keep on voting. But it's been this way for over 100 years since we've even had an income tax in this country. Next, dividends are classified as a return of premium, which is another significant tax advantage. We don't have a ton of time to get into that today, but just keep in mind, if you had a brokerage account with dividend-paying stocks, you better believe you'd have to pay some taxes on those dividends. However, with life insurance, they are classified differently, and that means there's no tax. Beautiful. Chef's kiss. Next up, income tax-free death benefit. So we're able to see the legacy left to your family without leaving another chunk of your hard-earned savings to your dear uncle over there in Washington. It's an income tax-free death benefit and a legacy you can be proud to leave. Next up, there's no impact on your modified adjusted gross income. Now that has the net effect of reducing Social Security taxes for you, and it reduces your Medicare premiums for you as well. And then finally, life insurance has no requirement to pull money out of it, such as a 401k or an IRA or SEP IRA or 403b or any of these conventional retirement accounts. These all are available for you to spend today in your 30s or 50s or 89s or 90s or beyond. This is, a free and truly your money. So with all that, I'm going to pass the ball back to Pamela for a few moments, and then I'll be back to talk about some real estate strategies next.
And I want to mention that I think that reducing Social Security taxes and Medicare premiums is very significant. It's currently 50% of all people paying taxes are being taxed on their Social Security benefits, which just shocks them when it happens. They're like, "But I already paid into the system. Now I'm being taxed on the benefits of it." And the Medicare premiums too. Reducing your Medicare premiums in your older years. I mean, how nice is that? Do you really want to be saddled with higher premiums because the money that you're taking from your 401ks and IRAs and so on is being counted by the IRS? And when you do bank on yourself, those withdrawals are not counted. So they don't raise Social Security taxes or Medicare premiums. So a lot of advantages there. And I know Mark has another great segment coming up. I'm going to share my screen in just a moment. But I do want to remind everyone that if you have a question or comment, click on the Q&A icon, not the chat icon, and type your question or comment there, and we're going to take as many as we can towards the end of the webinar. So let me just share my screen for a minute here. So if you're intrigued by what you've heard so far and are ready to take the next step, you might be wondering, well, why would you work with a Bank on Yourself professional? Or can any life insurance agent or financial advisor help you do this? Unfortunately, sorry about that, most of the financial advisors don't know what they don't know about Bank on Yourself, and a little knowledge can be dangerous. If the wrong company or product is used, or your policy isn't designed to maximize the power of the concept, your money could grow much more slowly. You could lose the tax advantages or both. And I found this out the hard way, and I want to make sure that you don't run into the same problems. The advisor who set up my husband and my first two policies swore up and down that he knew everything there is to know about structuring them properly. Unfortunately, about a year later, we got a notice saying the policies had turned into what's known as modified endowment contracts, which means they lost a key tax advantage. Our tax-free retirement withdrawals had just become fully taxable. I spent more than 40 hours, and I'm not exaggerating, 40 hours on the phone with the insurance company trying to figure out how to fix it. I finally got through to one of the top executives, and she told me she wished her advisors had never heard of Bank on Yourself because they had no clue how to structure the plans properly, even though these advisors were convinced that they did. It causes the bulk of the complaints that they get, and I wouldn't wish what we went through on anyone. Finding a financial professional who could design and implement a Bank on Yourself plan properly was so frustrating that it led to the creation of the Bank on Yourself professional training program. And since designing a Bank on Yourself type policy means taking a 50 to 70% commission cut, many financial advisors will steer you to a different product that pays them a higher commission and has few or no guarantees. And for these reasons and more, beware of any advisor claiming they can help you do this who does not have the Bank on Yourself professional designation. It's not easy to become a Bank on Yourself professional. Only 200 financial professionals in the U.S. and Canada qualify. I saw one question was, does this work in Canada? Yes, it does. There are rigorous training requirements for being a Bank on Yourself professional, and it's very selective. Admission standards are high, and only 1 out of every 20 applicants is accepted. Each Bank on Yourself professional has undergone many hours of additional training on the technical details that make these policies such a powerful financial tool. They've completed in-depth training and testing and demonstrated their competency with the concept. These professionals take continuing education classes on safe wealth building strategies. They work under the guidance of a Bank on Yourself technical and policy design team that has collectively designed tens of thousands of policies for the concept. They also work with some of the country's financially strongest life insurance groups, and they know which companies have the best policies to maximize the concept power. You might be surprised to know there's only a handful of companies that qualify. So the question is, are you ready to take the next step? When you request your free, no obligation analysis and recommendations at takeapositivestep.com, you'll be referred to a highly qualified Bank on Yourself professional who has met the rigorous training requirements and who is licensed in your state and who will show you how a custom-tailored strategy could help you reach your financial goals and dreams without taking any risks. They'll look at 8 ways to free up money to fund your strategy, sometimes at no additional out-of-pocket costs. That might include tapping your safe money so it works much harder for you, reducing funding of your 401k or other retirement accounts so you gain guarantees, tax advantages like the 6 that Mark was showing you, and control of your money. You could involve restructuring debt or converting old life insurance policies that weren't structured to maximize growth. And it's good to keep in mind that there is no such thing as a one-size-fits-all program. Yours would be custom-tailored to your unique situation, goals, and dreams. And there are strategies for people of virtually all ages, health conditions, and income levels, so don't count yourself out. You can find out what your bottom line guaranteed numbers and results could be if you added the Bank on Yourself strategy to your financial plan, so you can decide if it's right for you. Just go to takeapositivestep.com. That's takeapositivestep.com. Now, what about if you've already been referred to or are working with a Bank on Yourself professional? Well, then I encourage you to reach out to them to get your questions answered and ensure that you're maximizing the concept's advantages. If you can't find the contact information for that professional, send an email to support@bankonyourself.com with your full name and state. So I hope that you want to find out what your bottom line guaranteed numbers and results could be. Imagine being able to do that at the start, as opposed to saying, gee, I wonder what my results are going to be when I'm ready to retire, when I'm ready to draw on it. This is guaranteed bottom line numbers and results. You can find out now, and you can decide if it makes sense for your situation. So at this point, I'm going to turn it back to you, Mark, to cover a very common and quite popular use of the Bank on Yourself strategy, game-changing strategies for building wealth through real estate. Take it away, Mark.
Sure. Yeah, thank you for that. And I love the conversation so far. And by the way, you've got the best, coolest website names: Bank on Yourself, takeapositivestep.com. These are all fantastic. I hope everybody takes full advantage of reaching out to a Bank on Yourself professional. And I want to get into how this tool might be implemented for something as creative as real estate investing. Now, please understand that there's nothing guaranteed about real estate. There is a contractual guarantee with the dividend-paying whole life we've been describing. But I want you to realize just how powerful these two tools can be used together. Again, a Swiss Army knife is fine, but it's even more powerful when you can use it to help you unlock some incredible potential in your life. You know, the Phillips head screwdriver on that Swiss Army knife is only helpful if it's, putting in a screw or unlocking a door or whatever it might be. It's the relationship between the Swiss Army knife and the rest of the world that makes it just that powerful. And that's what I want to talk about next. So we all know, or many of us might know, that real estate investing is, a number of positive effects to us. It's a central artery in our country's economy. It's one of the oldest forms of wealth accumulation and preservation. Just ask the Egyptians and their pyramids. It's also a satisfying means for creating financial freedom. And so it's clear why many people have chosen to see real estate as a part of their overall financial portfolio. There's a stream of income from rental properties. Most of the time, it's less volatile than other assets might be. And of course, hey, Mark, I can live in it if I had to, right? So you can live in a duplex and do what they call house hacking, or just live in the property and watch it appreciate. Most homeowners have enjoyed house appreciation over the last 30 plus years. And the Congress has decided to make it a significant tax shelter, I suppose because the government's decided it doesn't want to be in the business of government housing for everybody. So it's a relationship with the tax code that's always enjoyed significant tax advantages. So you might be asking, well, Mark, why this whole Bank on Yourself thing? Why not just put all of our cash into real estate properties if it's so good? Well, ultimately, there's some downsides to this asset class too. So first of all, does the math really work? Historical growth of only 1% a year for the century up until the pandemic, if you adjust for inflation, is all we can expect from real estate. That's according to Robert Shiller of the Case-Shiller Index. And oh, by the way, it's not free to keep your property maintained, to buy the property, to sell the property. Heck, just to keep the lights on, it costs money to own real estate. And then you have the problem of non-paying tenants. And that became especially clear when many times the landlords were punished during the pandemic, and people were able to live rent-free without the threat of eviction. So when you really come down and think about it, the real estate deal that you have in your portfolio is only worth what someone's willing to pay you for it on the day you sell it. Until then, all it is numbers on a piece of paper, numbers on your balance sheet. So more problems, I guess, more hurdles to success in your real estate investment project or investment portfolio. One, ask yourself, when you own real estate, are you truly in control of the wealth or equity inside that real estate deal? I would say no. You need a bank to access the equity in your home or rental property. So you need to kiss the ring of the banker, one generous enough to lend you money or to do a cash out refinance. Meanwhile, many people could be underwater on their personal residence and have no access to the money that they've pumped into their mortgage over these many years. And in fact, the real estate bubble laid bare the fiction, as Pamela says, that housing prices only go up. And as you know, the financial crisis of 2008 is not just a one-off event, and there's local markets always facing real estate turmoil. And it's painfully clear how little control we have over our equity. But what about the growth of our asset? Is it possible that housing prices could go back down again? Is that possible? I'd say yes. There's nothing in stone written that my house price will only go up. So does a real estate portfolio insulate you from future financial crises? Ask yourself that question. And I like to just keep it real simple. When are you most likely going to need access to cash? If you're a real estate investor or anybody really interested in real estate, if you own your own home, when are you most likely going to need access to cash? That's right, during a crisis. And by the way, when are banks least likely going to give it to you? Think about it for a minute. That's right, during a crisis. And when are you going to have the hardest time selling your real estate at the right or fair price? Have you figured it out by now? During a crisis. So, is real estate an asset or is it a liability? Now, Pamela, our common friend Tim Austin regularly says that his dad jokingly, and I think seriously too, said that his house was not an asset, but it was a significant liability, right?
My husband calls it a money pit.
A money pit, yeah. One of the best movies of the 1980s, by the way. So if you're still thinking about paying off that mortgage aggressively, and I meet people who do all the time, and good for you for living within your means, but again, where you put that money makes it act differently. If you put your extra dollars into paying down your mortgage, what happens next? Well, the mortgage payment will earn you 0 interest. And every dollar you pay down on that mortgage is no longer liquid, and it's not even really yours because the equity is not guaranteed either. And in fact, you're penalized on a tax basis for paying off your mortgage because as you pay down your mortgage, there's less and less of the interest to deduct, isn't there? Mm-hmm. So there's several problems here with real estate investing. Let's talk about each one. Is there some predictable results? Couldn't you even have predictable results with real estate investing? I'd say no. I mean, sure, you can build models and assumptions, but you cannot solve the problem using the same thought process that created the problem in the first place. That's Albert Einstein. So my question is, with real estate investing, why are you doing it? And everyone here might or might not be a real estate investor. I get it. You might be dabbling. You might be a landlord. You might be just a homeowner. You might be doing wholesaling. You might be doing syndication deals of all kinds. We might have all kinds of people listening to this. But the question I have for you, no matter what you're doing, even if you're just watching this, wondering what in the heck is real estate, I get it. The question is, does your current financial plan focus on predicting financial results or planning for your results? Planning for those future results. I'd like to say, let's build a plan rather than a prediction. And that's where bank on yourself type whole life policies really come into play. Let me show you why I think bank on yourself and real estate investing have so much to do with each other. First of all, as Pamela has mentioned earlier, these are bank on yourself designed whole life policies, not just your typical, insurance product that you might find from your oh so average insurance agent. No, these are modernized with supercharged cash values. They're issued by mutual life insurance companies, not publicly traded. The gains each year you have received them are yours for life. They're locked in. You cannot lose the money you earned last year in your contract. And as we'll get to here in a minute, when you borrow against the contract value, when you borrow against the cash value in these policies, they will continue to grow even on the capital you borrowed. Now, right there, please tell me anywhere else in the financial universe that can say any of these things, much less
Yeah.
all of them.
I agree, and I just love that last part, that it does grow even when you're using the money elsewhere. Your money actually does double duty for you. And everything you're saying, Mark, applies not just to investing in real estate, but making major purchases, investing in anything. So I just wanted to point that out.
Absolutely. Yeah, this is meant to be a teaser, you might say, to get your imagination going. You know, it's as other people have said, it's an exercise in imagination. So let's continue on. Let's see. In essence, we control the money in our contracts. These are unilateral contracts. And by the way, if you think about it, isn't that what real estate is too? It's a contract. If you don't have, people like to think of real estate as physical, real. I can put my hand on the building. And that's all true. But if you don't have a contract to back up your ownership in that property, all you really have is squatter's rights. You know, whoever has the bigger shotgun is going to own that house. So it's the contract that really is the bedrock of wealth creation. That's true with real estate, and it's true with your insurance policy as well. So as you can see here, there's a number of different pieces. We're not going to go into each of these here, but you can take a screenshot if you'd like. And my question here is, what if we could use banking, the structure and function of banking, to our own advantage rather than being beholden to the disadvantages of having to rely on another bank down the street when it comes to our real estate? What if we could become our own source of financing and live the best life possible as a result? In fact, I like to think of bank on yourself in real estate sort of like nitro and glycerin combined. It's not either real estate or bank on yourself, it's both and. How can you use these two in combination to create an explosion of positive results? Well, here it is in 4 simple steps. Build a policy that's growing with significant cash value. And that can be done in a few months or a few years, depending on how you structure the policy. It could be right away within the first 30 days. But using that equity, the cash value in your policy, you might decide to purchase some real estate. Step 2, the policy will keep on growing, even on the capital you borrowed. And step 3, you've borrowed against that policy, so repay yourself like you would any other bank on a schedule that you control. Step 4, sell that property whenever you're ready and recycle the money back into your policy. So there are a number of ways to do this. Greg and Christy Gammon, who, Pamela, I know you interviewed them and have them in your books. They use their policies to flip properties. So they'll buy a low-cost real estate property, maybe in a rough part of town. They'll borrow against their life insurance to invest in repairing and rehabbing that property, and then they'll sell that real estate at a much higher price and pocket the profits. I want to show as we wrap up, as we get closer to the end here, before we get to your questions, and I see there's a number of questions, which is awesome. I want to show some numbers for the engineers on the call here. If you've made it this far, congratulations. Here's an example of one chart that I think will be especially helpful for those that want to see the numbers. So please understand, as we get into this, this is one person's example. Your numbers are going to be yours. You can take away a 0, or you can add a 0 to all of these numbers, and it's all pretty proportional. You can fund these policies for a couple of years or for a long period of time, like I'll show you here. But there are actually some advantages to starting these even in your 50s and 60s and even your 70s. So please keep that in mind as we're looking at these numbers. Okay, so with that out of the way, let's look at this guy's numbers. He was able to afford $1,500 a month. And by doing so, notice he's got $40,000 of cash value by the end of year 3. Come all the way down the page here to age 70 and check that out. He's got $1.2 million in cash value, and he's able to withdraw $60,000 a year income tax-free in retirement. Now, please understand, he didn't borrow from that policy for 35 years in this story. Now, I want to show you what it looks like when he does take a loan, but before I do, please remember the number that's been highlighted in yellow on the screen. Again, that's $1.26 million. Keep that number in mind And remember that he never touched the money. He just socked that money away in his policy. 1.2 million is way more than the money he pays into it. Now let's take a look at the exact same policy. And again, he's got $40,000 in cash value at the end of year 3. So at the beginning of year 4, he decides to take a loan for $35,000 as a down payment for some assets and real estate. And then he repays that loan with the rent from his real estate deals. And he decides to repay it at about $750 a month, give or take. And over the next 5 years, he pays that loan off. Now, just in case anyone was interested, there is interest charged on loans. But if you did the math here, you can pause and go back and look at this, the cost of borrowing is about 2%, 2.1% APR is my math here. So just to save you all some time, that's a pretty affordable way to access money in this world, especially today with mortgage rates triple that as we're recording this anyway. And who knows what they'll be when you're watching this in the future. So the point is you have complete control over this, and it's a low-cost way to access money. Now, meanwhile, he does that 6 times down the screen, as you can see it here over his lifetime. And Pamela, since you're unmuted, can you help anyone who can't see it? What is the cash value, even though he's borrowed against it 6 times? What is that number highlighted there?
It's identical to the number if he had never borrowed, 1.262 and change million. And that's the phenomenal thing. Now, Mark, we have to point out, this is a type, only certain companies sell this type of policy where they pay you the same dividends regardless of whether you have a loan outstanding or not. That goes back to why I said you want to work with a bank on yourself professional. They know which companies are the right companies to use for this. There are only a handful of companies that meet all of the requirements, including paying you the same dividends and cash value regardless of whether you have a loan outstanding or not. That's how you end up back at 1.262 million.
Absolutely. Yes, absolutely. And you're right. I've had clients who had a previous insurance agent give them some policies that were mutually owned companies that were dividend paying whole life insurance that even let them borrow from the policy. This one gentleman I'm thinking of now, he had 4 policies with a certain company. I won't name a name. $800,000 of cash value in several policies. He borrows against the policies to invest in some real estate. He gets a notice saying that all of his cash value has been borrowed against and he's no longer earning any growth while he had the loan outstanding. Of course, he was furious, much like I'm sure you were, Pamela, when you found out what you found out about your policies. So it's so important to work with a bank on yourself professional, as Pamela mentioned. But if you think about this guy had 6 loans. All I can show you on this chart is how the policy performed. What don't you see? Oh, you don't see the 6 apartment buildings and condos and rental properties and all the appreciation and all the rental income that he's enjoying from purchasing and investing in real estate using his policy. So my question really becomes, how many times can I do that over your lifetime, over my lifetime? How many policy loans can I take? And imagine how this might work with all parts of your life. Imagine paying off student loans with this strategy. That's what I started with. Or buying your cars, home repairs, vacations, and more. Or what about helping bring home one of your husband or wife home from work so they can stay home with the kids because you're not having to spend so much on credit cards, mortgage loans, and boat loans and more. Helping your parents, helping your kids prepare for major expenses such as college, or maybe starting a business, buying some inventory, or maybe buying into and really experiencing and growing toward a true and lasting retirement. I mean, help me. What else can you guys think of? Put that into the chat. How else might you use this strategy and your Swiss Army knife for your future? Think about that for a minute and put it into the chat. I'd love to know as we're wrapping up here. So again, what could you see yourself using this strategy for? That's what I'd love to know. And if you could put it into the chat, it'll just get my heart pumping just to think about all the ideas that other people have for this incredible strategy. Now, as we wrap up, what are the downsides? Well, I'm going to feel free to answer your questions here in a minute, but I'll just bring up a few. There are insurance costs. This is going to still take some time. You're not going to be able to see triple-digit rates of return within a bank on yourself policy, especially right away. And probably it's just going to be a regular, boring, steady, predictable yield over a long period of time. So you might even get some FOMO, some fear of missing out when you see the latest meme stock appear on the evening news. But this is meant to be a long-term savings strategy. And it's not for everybody. It's nuanced. It's a custom designed solution. You cannot buy this thing at Walmart or off the shelf. It's bespoke. It's custom tailored. It's for each and every person. That's why each individual is meant to reach out to us at takeapositivestep.com, and we'll do a one-on-one advisory consultation with you to make sure that this is even the right fit for you. And if it isn't, we'll tell you up front. If it is a good fit, then we'll design a personal numbers solution for you so you can see it, positive and negative. But please understand, it still takes rubbing some pennies together and saving, being able to redirect what you're currently saving or putting money from savings into a policy. Now, if you feel like you're too old or have some health concerns, I'd say don't rule yourself out just yet. There's lots of ways we can adjust this, including dialing down the death benefit or even insuring a family member or business partner to make sure you're the owner of the contract, but they might be the insured. So in summary, I would just say that the dividend-paying whole life insurance contract is the Swiss Army knife in the financial universe. And I'll summarize it with something really simple you can take away to someone that you might care about and want to talk about. Remember TGIF. I don't know if that's when MacGyver came on or not, if he was on Fridays or not, but he's the guy I think of when I think of TGIF Fridays, TV shows. TGIF stands for tax advantages and tax-free income. G, guaranteed growth, insurance protection, and financing every purchase by using your own source of financing. So TGIF. Take it away, Pamela. I hope you enjoy that little acronym. I had to squeeze that one in.
I do. TGIF. I had not heard that before, Mark. Great presentation. We have a bunch of questions, and Julia is going to has been picking out some of the questions. We'd love to answer all of them, but we're going to stay on at least for a while here and answer questions. And I did want to remind you that if you haven't yet taken advantage of requesting your free analysis that will let you take back control of your financial future, then you can go to takeapositivestep.com. But if you don't do it during the presentation, that's fine. Make sure you write down takeapositivestep.com and do it right after the presentation ends. But no two programs are alike. Even if you think you don't have the money, you'll find out when you work with a Bank on Yourself professional, because they'll show you 8 ways to free up money to fund your strategy. And you can find out what your bottom line guaranteed numbers and results could be, adding the Bank on Yourself strategy to your financial plan before you even decide if you want to move forward. And there's no cost to do that, no obligation, no arm twisting. You will be referred tomorrow. We hope we can handle this tomorrow. You will be referred to a Bank on Yourself professional, a highly trained Bank on Yourself professional who is licensed in your state, or if you're in Canada, who is licensed in your province. So at this point, Julia, I can see you've been answering some people's questions. Thank you so much for that. Are you ready to start throwing some questions at me and Mark?
Hi, Pamela. Yes, thank you so much. We have a lot of questions. Donald Ray asks, as a grandfather, can I open an account for my 18-year-old grandson without involving him with a lot of questions? I would like to think of it as a bank account that I can leave him after I pass away.
Oh, can I answer that one, Mark?
Sure. We'll go back and forth.
Okay. We did this for both of our grandchildren, and we started them when they were pretty young because we wanted them. Actually, when we first started them, we thought that would be a great thing to do when they get ready to go to college. Their parents wouldn't have to sacrifice their retirement to pay for college for the kids. And it worked exactly that way. One of them is in college right now using the policy to finance their college education, and they absolutely love it. And they're going to pay it back to the policy after they graduate, and they have income coming in, and then they're going to be able to use it throughout their life however they choose, taking loans, paying them back, not having to pay in. You're still getting the same growth regardless of whether you have a loan outstanding, and then they'll have an amazing, secure retirement security. So yes, and they didn't have to answer any questions because they're not. In our case, we didn't make them. They're not the owners of the policy. They're too young for that. But we turned the policy over to one of our grandchildren when they reached a certain age, got married, and got a job. What's the next question?
When you're already retired, should you still consider this as an option?
Mark?
Sure, I'll bring this up. We actually work with folks that are at all stages in life, and including folks that are already retired. In fact, there's several strategies that are better for folks if you're over 60 years old when you start your Bank on Yourself policy. So, even up till age 85, you can be the insured. So just to quickly answer the question, yes, is the short answer. There's lots of ways you can structure these policies at any age, from 0 years old to 85 years old.
Great. Next question is for Mark. Mark, meet Mark. With the bank failures of the past and the bank currently under stress and many predicting a 1929-like financial crisis, how sound and secure is the bank that Bank on Yourself programs use?
It's one of my favorites. So look back to the past. The fine piece about Bank on Yourself is it's so old, you can see how it did in the past. In 2008, great example, 450 banks, not bank branches, but entire banks went bankrupt. Think about that. That's almost a quarter of the entire country's bank industry went bankrupt in 1 year. Now, how many life insurance companies that were mutually owned, like we like to promote around here, how many of those went bankrupt in 2008? I'll give you a clue. It rhymes with hero. All right. Now, what if they did go bankrupt? I don't know. I guess that's technically possible, but what would the rest of the financial universe do? What would the rest of your financial portfolio be doing in a world that would be worse than 2008? How would the stock market be doing? Just for example, a real estate market. Now, I'll answer the question, Mark, because I like your name. The the answer is, generally speaking, the state insurance commissioner would step in and act in your best interest and usually operate the failing insurance company to your benefit. And very likely they would pass off the contract. Remember, this thing is a contract. And even a failing institution cannot wiggle out of a unilateral contract all that easily. So there are a number of safety net provisions, as Pamela talks about, where you might just be passed off to another financially solvent insurance company, so your guaranteed growth and protections would continue. Pamela, would you add anything to that?
Just that back in the Great Depression, what was it, over 10,000 banks that went under? Does
Wow. Yeah. I don't know that stat, but that
it was
could
a
be.
lot.
Yeah.
It was thousands. And if you Google like how many life insurance companies went under during the Great Depression, you'll have a hard time finding one.
Yeah. Yeah, and they're meant to be this way, Mark, because there's a reserve requirement that is so high to operate as a life insurance company that you literally can't open your doors unless you've got more substantial reserves than the bank. Look up the phrase fractional reserve banking on the internet, and you'll see what I'm talking about. The banks are on a razor thin edge, and that's why they're so volatile whenever markets crash and times are bad.
Mark has a follow-up question. What happens if the US dollar fails?
Okay. Yeah, we've been getting some of these. So what does he mean by fail would be one of my questions. But if he means no longer the world reserve currency, then let's think about that again just for a minute.
Yeah.
And there's probably a longer conversation you could have here, but it's still going to exist. And even let's talk about first nightmare scenario that it no longer is the world reserve currency. Well, again, you still have dollars, and there's still a number of different things that are denominated in dollars, and likely the inflation rate would go way up, wouldn't it? So that would crash a lot of things, including bonds, including the stock market. Basically, everything would be on in a bad way. And I'm not saying that you would be totally out of the woods with any dollar-denominated asset, but think about it. Whole life insurance premiums are guaranteed never to get more expensive. So right there, if we go into an inflationary world, that makes your premium super easy to pay for. Everything else, milk, gas, is getting more expensive. Only your whole life insurance premium is literally guaranteed not to be inflated away into, the stratosphere. Second, guess what happens to dividends on whole life policies when interest rates go way up and stay up for a long time? In
They go
1980,
up
we got to see this
too.
happen. Yep. Pamela, go for it. Say again.
Nope, they go up too. They have go ahead, take it. No, that's fine, Mark.
Yeah. The inflated, the inflation rate isn't going to be instant, but over the next prevailing year, 2 or 3, you're going to see dividends going into double-digit territory if we have double-digit inflation. So is this a cure-all? No, but it's a way to protect against hyperinflation. And it's something that I feel like is a great salve because your money has to live somewhere. So in the meantime, right, put it into a policy. And if you knew, for example, that we were leaving the dollar forever and moving to water bottles or gold, you could borrow from your policy and buy all the gold you could buy.
Just a comment about that. Keep in mind, I pointed this out earlier. These policies are guaranteed to grow by a larger dollar amount each year. Guaranteed to grow by a larger dollar amount each year. And I would also suggest that anyone who has questions about the safety of Bank on Yourself or those economic what-if scenarios, I address all of them at bankonyourself.com/safety. That's bankonyourself.com/safety.
You really have done a lot there on that article. Inflation, deflation, stagflation even. So yeah, there's a great resource there, bankonyourself.com/safety.
Julia, what's your next question?
There was another question that was kind of in tandem with that last question that we had, which was more of a what happens if the dollar switches to like a different type of currency, an e-currency?
Yeah, I could just briefly say that, there is you're buying a contract, you're not opening a savings account. So the contract would be denominated in the legal tender of wherever you are, what state you're in when you issued the contract. So short answer is you'd have some recourse if you move over to, some sort of cryptocurrency or something like that. And I've had this verified by several different life insurance executives as well. Remember, it's a contract. That's the key to remember. You're building contractual wealth. You're not saving money in a bank account here.
And we've had a couple of people ask about IUL. Can Bank on Yourself work with IUL?
Pamela, I'll let you go for that one.
Remember when I said that a lot of financial advisors will switch you to a different product, and the hot product right now is IUL, which stands for Indexed Universal Life. If you Google, the quick way to find out about this is Google IUL or Indexed Universal Life lawsuits. You will be shocked at how many people have already lost money in their IUL policies, how many of them have been hit with premium increases where they become forced to pay significant, like we're talking about 10 times the premium they started with or even more, where if they want to keep their policy in force, they have to start paying significantly more money. There's games that they play that the regulators are constantly trying to rein them in with showing illustrations that make it look like the sexiest, most amazing thing you've ever seen in your life. And if you think something looks too good to be true, it usually is. And if you take a look at the small print in those illustrations and those policies, you will find over and over the phrases fees, no guarantees, not guaranteed. You will be amazed. But the people selling these will typically not point those out to you. But I would say just Google IUL lawsuits. That ought to address the whole question. Is there something you want to add about it,
No,
Mark?
that's perfect.
What I would again suggest, go to bankonyourself.com/safety, and it does address inflation there. But generally, they follow inflation. And so dividends increase as interest rates increase and inflation increases. They generally keep up with it.
And I'll just say, to add to that, how's real estate doing with higher inflation? With mortgage rates at 6 or 7 or wherever they might be, in the future. Who knows where they might take us in the future? It could be less, could be higher, right? That's only going to bring more advantage to those of us that have whole life policies to buy the real estate. Because if nobody else can afford the mortgage, guess who can? Guess who can? It's the folks with the bank on yourself type policies ready at the courthouse steps to pick up those sweet deals.
All right. We do have a couple of questions about underwriting, medical underwriting, and more specifically, is there a law that insurance companies must reveal why an individual is denied? That's from Tally.
A law that, no, I don't know if there's a law necessarily. Since the insurance companies are regulated by the states, there might be a state by state law, but I don't believe there's any kind of forcing them to tell you whether or not you were approved or not approved. But I'd say that it's probably in their best interest to share as much information. It's your medical information after all, but it is their proprietary decision as to whether or not they would approve you or not for any reason, right? They're a private company, so they can do what they want, I suppose, and there's no obligation to approve us when we apply for life insurance.
Well, here's another point. We regularly do trainings on, in fact, I think we have one coming up in a few days for the Bank on Yourself professionals on how to navigate underwriting, because different companies that the Bank on Yourself professionals work with have different underwriting requirements. And I've been amazed by some of, you would think, oh, that person would never get approved. And they were, sometimes at, regular rates. And the other part of it is, and when you work with a Bank on Yourself professional, you go to takeapositivestep.com, they will help you figure out whether you should be the insured or someone else. Because as long as you're the owner of the policy, you control the policy and the money in the policy. You do not have to be the insured on the policy. My husband became uninsured some years back, but we keep buying policies. It's not something that should get in your way. But don't make decisions about yourself. Talk to a Bank on Yourself professional. Again, we have several companies. They have several companies that they work with, and each one has different requirements. And then they can work with you if you're really not going to qualify or going to be highly rated. Then they're going to say, who else could be the insured? You're still going to control the policy and the money in it.
And while we're talking, I see Sammy has written a question. I'm 82 years old now. If I get a policy, would it end when I'm 85? Sammy, I'm sorry if I miscommunicated. You can buy them as young as 85. It lasts until you're at least 120 years old.
121.
121. Thank you. Yeah. And if you're still around at that point, I think they send you your death benefit and a check in the mail with your biggest birthday card they could probably find.
John has a great question here. He says, can I use my 401k to fund a Bank on Yourself account?
I can go for that one there.
Yeah, the short answer is yes, and Mark's going to explain a little more.
Yeah, I'll be brief as I can as I see our time. So short answer is yes, you can use the question was, can I use my 401k to fund my life insurance? One way to answer it is no, because there's no direct rollover from 401k to life insurance. Okay. So the government, strangely, and I think very curiously, does not allow you to put life insurance inside a 401k. There's a lot of discussion we could have there as to why I think that is. However, you are unable to put money like directly from 401k into life insurance without taking it out of your 401k first. And by doing that, you expose it to the taxable heir. You pay your taxes today while you know what they are before tax rates go up for good. And then you can use that to smartly fund your life insurance where it never gets taxed again, as the tax law says that we went over a lot of the tax advantages of life insurance. So a lot of our clients make their own choice, to take money out of their tax-deferred IRAs and 401ks, smartly and systematically paying their taxes in a reasonable way, and then funding their life insurance so they can leave their family a tax-free death benefit which oftentimes is greater than the original 401k balance, by the way, or setting up a retirement that doesn't get taxed in their cash value in their life insurance policy. And Pamela, you've written several books on this, including Rescue Your Retirement, which goes into an example of how to do this.
Right, exactly. I would just mention, too, I only mentioned very briefly guaranteed lifetime income strategies, but the Bank on Yourself professionals are also experts, and they're very highly trained on those strategies. And those involve different, it doesn't involve a life insurance policy or the underwriting that's involved in a life insurance policy, but they are experts in showing you ways that you can make sure your money is guaranteed to last as long as you do. So that would be another reason and some people start those plans pretty young. I mean, even I've seen people starting them at 30, 40, 50, but often it's people in their 60s, 70s, or 80s that are doing that. Do we have another question we should answer, Julia?
We do. We have so many questions. Thank you, everyone who had put a question in the Q&A. We're going to try to get to as many of them as we possibly can. We always get the great question of what's the difference between Bank on Yourself and infinite banking. Does anybody want to touch that one?
I'll go ahead and touch that one. Yes. So, infinite banking concept was started by the late Nelson Nash, and he was my early mentor on the concept. And I learned so much from Nelson and from the infinite banking concept. We feel that we've taken it a bit further in the way we design Bank on Yourself policies, because we add multiple options to the policy. And we've compared the growth of both the cash value and the death benefit, doing it the way the Bank on Yourself professionals do. And it's higher on both counts over time. You are going to over time, you will have more cash value and you will have more death benefit. And we're very proud of the Bank on Yourself professional training program. We think it is the gold standard of training in the industry. But if it hadn't been for me coming upon being introduced to Nelson Nash and the infinite banking concept, I would still be losing money, wondering if I'd ever be able to retire, wondering if I'd ever be able to stop worrying about how much money I was going to have when it was time to retire. So I owe a lot to Nelson Nash.
Absolutely, me too. I will just say that I've seen in the wild many people who wear a lot of nicknames around this strategy. And these days, anybody with a life insurance license and an internet connection can talk about this, whether or not they understand it. Right? And so there are a number of nicknames and knockoffs. And as you said, Pamela, I think you smartly created, with Nelson's assistance, a credentialing and authorization and really continuing education designation program, the only one that has any kind of merit to it with any kind of like quality control. I liken it to the difference between USDA organic and all natural. When you get USDA, you know what you're getting, but when it's healthy / all natural / whole grain, it's hard to know what you're getting. And there's just so many nicknames. We don't have time to name all of them. But let's just say you want to make sure when you get on that airplane that it was designed properly and that the pilot knows what he or she is doing. So all you have to do is sit down and enjoy the flight. There's a lot of engineering and nuance that goes into building these things, but for the user, it's easy enough to just sit down, relax, and watch the money grow.
Thank you guys so much for taking the time to answer all the questions. And I think our number one, most overwhelming question of the day is, can we have a copy of this presentation? I have a family member, friend, coworker, somebody who needs to see here and listen to this. Can we please have it?
Oh my gosh. Well, I had no clue that many people would be asking for that. Let us discuss how the best way to do that over here. And if I'm sure we'll probably decide we can share it, in which case we will make sure that you, because you attended today, that you're among the first to know about it. We really appreciate that you found today's presentation of value and that you want to share it with people that you care about. That might be the most amazing gift you can give to people that you do care about, your friends, your family, your colleagues, and so on. I am so grateful for having discovered, come across the concept, and then I decided not enough people understood it, not enough people knew about it, and I was going to devote my life to making it accessible to ordinary people, because I'm not that smart, and I need things broken down into real simple things. And so that's what I spent the last 20 years doing, trying to break it down into simple things that anyone can understand, including myself, and so that we can have a worry-free, stress-free financial peace of mind for life. And I so appreciate everyone joining us today. If you like what you heard today and you want to hear more of this type of thing, we'll get into different ways people use Bank on Yourself, different strategies and so on. Let us know, put it in the chat box, and we'll make sure that we look at what you're specifically interested in and seeing how we can give that to you. And again, I appreciate you taking time out of your busy day to join us today. Mark, you're amazing at the way you describe it. I was so happy to just have a different way of explaining some of these concepts that people could go, oh, okay, now I get it. Or I love the way Mark explained this. And I really do love the way you explain things. So thank you so much for what you've done and for sharing all of that today.
Thank you.
So at this point, I think we're going to let everybody go, but do go to takeapositivestep.com. That's takeapositivestep.com before you forget, and request your free analysis. And it's late East Coast time, so it'll be tomorrow, but we'll make sure that the Bank on Yourself team gets you in touch with a highly qualified Bank on Yourself professional licensed in your state. So thank you, Mark. Thank you, everyone. You all have a great day.